if the Bank of Canada doesn't get moving on pulling the punch bowl back from the party, it risks having to move more quickly at its next meeting and subsequent meetings and move rates higher than they otherwise would have been in order to get inflation under control.
Welcome back to the Midweek Exchange. I'm Natalie Nanowski. And as always, I'm joined by Brett House, Scotiabank's VP and Deputy Chief Economist. He's here to break down those big economic issues and explain what they mean for your day-to-day life. Hi, Brett. How are you doing today?
It's good to see you, Natalie. It's a big week in central bank land.
It really is. And we got a little bit of a surprise because we were anticipating a rate hike from the Bank of Canada, but we didn't get one. Why?
Well, you're right. The markets were tipped toward expecting a rate increase to begin a hiking cycle by the Bank of Canada this week. We also were in the camp that said that the Bank of Canada should move and begin raising its key policy rate. And that was based on the data that we have so far on the Canadian economy in terms of the recovery and labor market developments. It also reflects the models of the Canadian economy that we use to forecast what's going to happen this year and next year, which are very similar to those used by the research department of the Bank of Canada. And they were saying very clearly, it's time to begin raising rates.
Okay, so if the Bank of Canada chose to delay its rate increase, what is this going to mean for our economic recovery? Could it have a negative impact?
Well, the Bank of Canada laid out some steps in its communications leading up to today that it wanted to see in place before it would raise its key policy rate. And it chose to delay today, we think, mainly to try to preserve credibility around the communication on the things that we need to see before it moved. But it did so in a way that is slightly at cross purposes with itself. If you look at the statement the Bank of Canada put out announcing its rate decision, it made it very clear that potential growth hasn't gone up, but inflation expectations by the Bank of Canada have risen with higher projected inflation this year and next year. And it was very clear that output gaps have closed. And so the space that still needs to be recovered in the Canadian economy to justify keeping the rate on hold is no longer there. Now, looking forward, you asked, would this have a negative impact on the continued recovery? Possibly it could, because right now we are seeing strong price pressures. And if the Bank of Canada doesn't get moving on pulling the punch bowl back from the party, as one US central banker once called a rate hike, it risks having to move more quickly at its next meeting and subsequent meetings and move rates higher than they otherwise would have been in order to get inflation under control.
Right, so we'll definitely have to keep our eyes peeled and ears to the ground the next couple of months. Now, in terms of our next week, what are we looking at there?
Well, we've got Canadian GDP for November coming out on Tuesday of next week. And that's an important number because it also plays into how the Bank of Canada is thinking about monetary policy and when it's time to start removing the exceptional stimulus that remains in place. We think that's going to be at its March meeting now, given that they didn't hike this week. That GDP number is likely to come in pretty strong. All of our readings on the fourth quarter of 2021 imply a handoff to 2022 that is much stronger than the Bank of Canada was previously estimating and further plays into the need for monetary policy to be tightened.
Perfect. Thanks so much, Brett.
Great to talk with you.
Great to speak with you too. And the Midweek Exchange will return next Wednesday.